Thanks everyone for tuning in. This will be the third video in this series of presentations on quantitative analysis and day trading. So do make sure to subscribe for more videos like this. So we'll be talking about four concepts today, starting with how to handle an ever-changing market, aka a continuum. Then we'll go on to how to implement frames rather than rules, allowing you the flexibility needed to profit in tumultuous markets. We'll also talk about the power of multiple scenario casting and how it prepares you for the unknown. Lastly, we'll talk about the time to use absolutely rigid rules. We traders, and humans for that fact, like to think in binaries. Something is either right or wrong, evil or good. It's hot or cold. The reason we like to do this is it spares us the mental power of having to constantly analyze a problem and find the new answers all the time. And the answer often lies in the gray rather than the black or white. We do this because it's the easy way out, the path of least resistance in our neurological circuits. Applied to markets at any given moment, it's either up or down in our heads. But we neglect that a market can range sideways for much longer than we have ever thought. It's the last probability a trader considers, that a market could go sideways for 3 to 4 months. But does anyone know that a market would do that? Does the market maker know? Well, not necessarily. As a market maker, you also want to make a profit. You're also a trader. Just one that has a lot more money and has to trade every day. And since he always has to trade, he needs other traders to take the other side of the trade. And to know how and where these other traders are, market makers have to test tests of liquidity. Now we'll see later on how these tests are done. It's usually with quick quicks up or down. But the idea is market makers will decide how to move markets based on the results of these liquidity tests, which implies that even the market makers don't know beforehand the path the market will take to reach a certain area. But instead, this is determined continually based on the results of these liquidity tests. This should give us the understanding and the insight into that we shouldn't attach ourselves to a certain path that price will take, a certain way that a price will reach its target. Rather, we need to keep an open mind for how liquidity is tested and handled, and the next possible paths from there on. Because no one knows. And that is what a continuum is, a thing that is constantly changing. As soon as you start seeing it for what it is, it changes again. So where does your strict trading rules fit in a continuum market? To approach an ever-changing continuum market, where liquidity is the main motivator of movement, a certain open-mindedness and preparedness is necessary. If so happens, then I'll do so. That is a rule. A rule takes into account one condition and one outcome. The problem with that, it's too limiting and rigid for financial markets, where the unexpected often happens. We need more possibilities, more conditions, and more outcomes to be able to take advantage of these markets. Now, if we multiply our condition by 4, this gives us a frame instead of a rule. A frame takes into account 4 conditions and 4 outcomes, like the big square we see on the chart, consisting of 4 smaller squares, each presenting a different probability or a different condition and outcome. Using different frames to approach different markets is very powerful. For example, a bullish frame with 4 conditions to approach generally bullish market and vice versa. This keeps you flexible and open-minded, enables you to take advantage of more markets rather than that one moment that fits all your rigid technical rules. This doesn't mean you can go on trading any market in any condition. Certain criteria has to be met before we consider trading a market. And I emphasize criteria. We don't want to trade ranging markets, but rather find a trending one and increase our probability of winning by being prepared for all different ways that trending market can go up. And always have a last possibility and scenario of that market could actually reverse and this could be the top of this bull market. And that's what we have right here in this generally up and down market. We have two possibilities of this market going up, two conditions and two outcomes of in one direction, and two conditions and two outcome in another direction. Many traders will often be 80% correct about the direction a market will take, but still lose money. This comes back to the reason that the path a market will take to go up can often be convoluted and most unexpected. That's how the unexpected will make the most of you as a trader. But this doesn't have to be the case. Once decided on direction, there's generally only 4 scenarios you need to be aware of. Only 4 scenarios drawn right here. We'll go through these one by one. So the first one being up, then up in the red right here, which is up right away. That's one way a market will catch complacent traders off guard and leave them in the dust. So market makers at all times see the liquidity in a certain markets because usually they are the liquidity providers of that market. They're the main vendor to sub-vendors, which are usually the exchanges, for example, or the brokers, and to the end consumer, you can call us retail traders that. So market maker does see how many traders are involved in a very raw fashion, that is. Namely, they have all the numbers. So if a market maker sees that traders actually have their limit orders under this pivot point right here, market maker would decide to take the market up right away instead of giving these traders a chance to join the trade and leave them chasing higher up and liquidate them later on that way. So that's one way. The second way a market can go up is go up first, incentivize FOMO, make people chase, correct sharply, liquidate latecomers, then proceed to go up quickly, which is the up, down, then up scenario. This will be decided by market makers after the initial first spurt and the test of the supply and demand. If the market maker sees on their book that now there's a lot of traders that have joined above this, there's a lot of buyers that have joined long above this point right here and have their stop losses under this point right here, market makers will take advantage of this. The third way a market can go up is to go down first. If a market maker sees that there's a lot of early bulls in this trade already at this point right here, instead of going up here and giving them a little cookie, some profit, because there's some smart traders that will manage to take profits above this point right here, what market maker will do is take it down immediately because they will also see where your stop losses are, and then will go up. So it's called a down then up scenario. The final scenario, and our least favorite in a bull market, and usually the least probable, is that this is the top and markets go down, correct weekly, then continues going down. It's the down then down This kind of scenario casting doesn't come naturally to human beings. We are wired to be heavily biased and to thereafter look for anything to confirm that bias. So it will take a lot of practice for this to start coming to you naturally as a trader, but once you get there, this practice will set you apart from 90% of other traders that look at markets in a binary fashion, which is up now or down now. And here we see which of the four scenarios played out. Namely, down first, then up, which is the green one. Now in this particular case, you might have been taken out on a wick right here, but you should have gotten back in because structure was not broken. Because in our books, this wick right here is a liquidity stop loss hunt of the stop losses under this point, because it's a wick break rather than a candle body break of this. Since the market, as we said, is ever changing, you as a trader need to be flexible when it comes to what setups you're willing to trade from day to day. But at the same time, this doesn't mean that you don't need to be disciplined. Discipline is a huge part of a trader's success, but it plays the biggest role not in literal rigidness to price action, but rather in the management of your own psychology. There should be rigid rules in place to countervail the eventual frustration the market will throw at you some days. Some days you lose your first 3 trades within the first 30 minutes of the trading day. You take that as feedback that your analysis might be faulty and call it a day. The probability of you making a good trade after that drops sharply, even after the second loss. That's why we reduce risk percentage after the second loss. That's another rule. Other days, you'll wait a few minutes to put a stop loss in after you enter. Market sharply moves against you, you're now caught and praying for a pullback. To countervail that, use a trade manager that automatically places a stop loss at entry. There's many available using MT4 or MT5. Many more rules like these contribute to 1% improvements until the whole picture is complete. Thanks everyone for listening. Don't forget to subscribe for more videos like this.